welcome to the SlateStone 2025 SlateStone Investment Outlook. And today I have the pleasure of talking with Ann Sonders. Now, many of you may know Ann Sonders. She is the Chief Investment Strategist at Charles Schwab, and she's got a range of investment and strategy responsibilities, reaching from market and economic analysis to investor education, all focused on the individual investor, where she interprets this on behalf of Schwab clients and SlateStone clients. I'm very happy about that. It's a pleasure. I've known Ann for two decades. Let's just leave it at that.
I think it might be 3 decades, Kenny.
Okay, but I didn't want to say 3, so let's give it a 2+.
I don't care. I'm proud of my duration on Wall Street.
Yeah, no, I hear you. I want to just so the audience understands one thing. Ann has been named one of Smart Money's Power 30, right? Their list of the most influential 30 people on Wall Street, the best strategists of the year by Kiplinger's, one of the 25 most powerful women in finance by American Banker. She's one of the top 50 women in wealth by Wealth Manager and Advisor One. She was also recently named to the Barron's 100 most influential women in finance. So, ladies and gentlemen, it is a pleasure for me to have you with us as I talk to Ann about current markets, what's happening in the markets, because God knows there's a lot happening, especially over the last couple of days, but really, kind of the view in 2025 and where we're going and where we might end up. So, Ann, thank you very much for joining me. It's a pleasure to have you.
Oh, I love having these conversations, and I would much prefer it to be in person. Yeah. But you're Italian. Your arms are going all the time. I'm Norwegian, but I am too. We would probably be knocking each other out if we were in the same room. So it might be better that we're on camera.
Yeah. I'm actually up in New York right now, and so you're down in Naples. This works perfectly, right?
Yeah.
But anyway, so let's talk first broadly about. There's a lot going on, and there's been a lot going on, especially over the last couple of days, week, coming into the market, into the stocks. The S&P was just recently kissing all-time highs at 6150 just 6 days ago, and today we're below 5,900, and there's been lots of angst and nervousness, specifically in the tech space, which I'm really not surprised at. We've discussed it. They've taken tech a little bit stretched for a while. It hasn't really corrected. While the index may only be off, I think as of tonight, it's off about 5% off its high. There are a bunch of individual names in the Mag 7, leading those troops that are down into correction territory. Yep. In fact, I think the Mag 7 today, the index today, is actually now entered correction territory. Correct. So talk a little bit just about that so we can lay the groundwork for the audience.
Yeah, so needless to say, there's a tremendous amount of uncertainty, policy-related uncertainty, for obvious reasons around tariffs, DOGE, immigration, but also, and it's connected, monetary policy uncertainty, with the Fed having gone from easing mode to pause mode. But interestingly, I think there's multiple threads of what the implications are of this uncertainty into the market. It's not just about tariffs. Some of it is, given that tariffs actually are already on in terms of imports of Chinese goods, and retaliations have started to get announced. And the tech sector specifically, but many of the Mag 7, they derive a decent percentage of their sales from China. So they're more exposed to some of the uncertainty with regard to the U.S.-China relationship. But we also have the convergence that is happening that we started talking about a quarter ago, that was well before the election. It was before tariff uncertainty. And that is that the Magnificent Seven as an entity over about a 5-quarter period of time is going from a peak of about 60% earnings growth to, by the end of this year, high teens, assuming that's an accurate forecast on the part of analysts. At the same time, the rest of the S&P 500 is actually accelerating from low single-digit growth in earnings up to sort of mid-teens. So one thing that's always important for investors to remember, I had somebody say to me, but they're still growing at a faster pace than the S&P. Close to 20% growth is still strong. But you've probably heard me say it, Kenny, over the years. Better or worse tends to matter more than good or bad. Rate of change when you have inflection points. So that's the way to think about some of the deceleration we're seeing in the earnings outlook for many of these stocks. And then, of course, the DeepSeek news and creative destruction that's happening in the AI space, which long term, I don't know that that's such a bad thing. I think that's democratization innovation and creative destruction, and ultimately that's, I think, for the good of the broader public and society.
Right. And to your point, we were talking before we opened the meeting up, we were talking about DeepSeek and creative destruction, and the fact that this whole group has spent tons and tons and tons of money, developing it and creating it and doing all that stuff. And then you have a disruptor come in, which is kind of what we saw with DeepSeek. Although I'm not convinced yet that DeepSeek is the disruptor yet. Do I think it woke everyone up and kind of shook the branch a little bit? Sure, but I'm not sure necessarily that you gotta nail a coffin shut on NVIDIA.
I think you're right, Kenny. I think they're a disruptor, not necessarily the disruptor.
But
that's the nature of what happens. It happened with the internet. A lot of money was spent initially in CapEx, and then disruptors come in. The world figures out how to do it cheaper. It's more readily available, and that's just the nature of innovation. The other thing we were talking about before we came on is DeepSeek, interestingly, came out of China, but it's a quant hedge fund in kind of the recesses of China. This wasn't some state-owned enterprise, government-monitored company, and that is also suggestive of disruptors can come out of anywhere. It happened to be a quant hedge fund in China, but it could be someone in their garage in Des Moines, Iowa.
Right. But it's interesting that when that news came out, that wasn't completely clear. The way the headline read, you thought it was out of China, right?
Well,
that it was...
you know what, Kenny, I'm glad you said it that way, because I think there's too much shorthand that happens in headlines. And I'll talk about that in the context of tariffs too. It drives me crazy because when the headline is tariffs on China or tariffs on Canada or tariffs on Mexico, it's the real way it should read is tariffs on goods imported from Canada, from Mexico, the tariff being paid by the domestic importer. And the only reason we know that shorthand, I read tariffs on China, I know what that means, but I can't tell you how many conversations I've had with people who don't realize that.
Right. 100%.
They think, tariffs on Canada means in order for Canada to, ship a product to us, Canada has to pay a tariff to the US. And that's not how it works. So that's why I always get a bee in my bonnet about the shorthand of headlines. To your point about the DeepSeek news was came out of China. It just happened to be where that hedge fund was located.
Right. And I think that part of the headline is what created all the angst that day, right? Because it was unclear. Now, until you said it, I didn't recognize that, right? All you recognize is what you read and what the headline said. Right. And I think that was actually part of that cause for a complete meltdown that day, right? People just saw, DeepSeek out of China.
Right. From China. Yeah. Yep.
Right. And I think that created certainly,
I think it was more of a DeepSeek that happened to be based in China. As opposed to the disruption came out of China.
Right.
Maybe that's semantics, but I think it's important.
Right. But had the semantics been the way you and I just discussed, maybe the reaction would not have been as negative as it was that day. Because I do think that was the way the headline was written, is the way everyone interpreted it, because that's what everyone, that was the panic, right? Oh my God, it's coming out of China, right? Which I thought was very interesting. But it'll be interesting to see now tomorrow NVIDIA's results come out. I suspect that, NVIDIA, Jensen Huang is not going to disappoint. I always tend to give him the benefit of the doubt, and I'm never really disappointed. But it's very interesting. The market is always looking. There's a trader, someone always looking for something negative to focus on so they can hit the sell button when the news comes out. Because typically, NVIDIA will report, they sell the stock off, and then a day and a half later, it's trading at new highs again, right? Because the report.
But that's the nature of a stock like this.
Correct.
Another thing we were talking about is when the DeepSeek news came out, lots of headlines around the fact that NVIDIA had the single largest market cap loss in a day in the history of the S&P 500. But as I said to you before we went on camera, the top 12 biggest single day market cap losses, 8 of them were NVIDIA. So when you have these high momentum, beloved stocks, there can be short-term downside. And sometimes it can be really swift and pretty painful. And it's just a reminder of the volatility.
And because it's so crowded, everybody's in it, or everybody's got exposure to it. And so everyone's kind of sitting on the edge of their seat, about what are they going to say tomorrow? What are they going to say? It's interesting. They've taken over the last 5 days, $15 out of the stock. It was traded at 142 just a week ago. I think it closed at 128 tonight or 127. 121 is the long-term trend line, and I've been saying this in my daily note that I want to keep my eyes on that level to see whether or not if they sell it down there, if it in fact holds. Because if it fails that trend line, you're going to get the algos that are programmed on breaches in technical patterns to go into sell mode, right? And so they'll kick it down again. Potentially, if you look at the chart, they could kick it down to somewhere 110, 115 if they do it. It's interesting though. Today, I thought maybe it was going to happen today, and it didn't. It traded down, I think, 122, and then it rallied back to close at 127. So maybe they've already accounted for what they think might be an interesting report tomorrow. But like I said, I think he's great. I don't think AI is going anywhere. I think Nvidia is going to continue to be kind of at the core, at least for now. And so I'm not setting my hair on fire as we all sit around and wait.
You're more the individual stocks person than I am,
right.
But you can't ignore NVIDIA, even if you don't cover individual stocks, because it is such a bellwether, obviously.
It's a bellwether now, right?
Yep.
It is a bellwether, and it's a bellwether in a different way, certainly in that space, which is very hot, right? The tech and the AI space is very hot, because Walmart's a bellwether too. And look what they did to Walmart the other day, right? Walmart, different from NVIDIA, but it's a bellwether kind of in a different space, right? In terms of
whether it's a Walmart or NVIDIA, there's messaging that is much broader than the individual company. Obviously, Walmart is the proxy for the consumer. NVIDIA is the proxy for AI. So these are meaningful releases from companies because of what they represent actually in the economy, but also in the zeitgeist.
Right. And it also is the way that they, it's the way people hear what they want to hear, right? You and I could sit in the same room and someone's going to say something. I'm going to hear one thing, you're going to hear it a different way, or somebody else is going to hear it a different way. So people will react. I thought the Walmart reaction was an overreaction, but that was me. Anyway, listen, because we could talk about this all day, but I want to move on because I want to talk about where we are, especially after today's consumer confidence number, which came in much weaker than even the expectation. And that created a lot of angst today in the market and kind of sell pressure, although the Dow ended up closing higher. The Dow was weaker in the pre-market. They rallied, it sold off, it rallied again. I think it closed up a couple of hundred points. But what does that say? Talk to me about what are you hearing out of that number today, and what's it mean to you?
So it was weaker than expected. Not terribly surprising given the grave amount of uncertainty that exists right now. You're seeing it in all the survey-based data. You're seeing it in expectations data. You're seeing in, CapEx intentions data. You're seeing it from large companies, small companies, and obviously the consumer in this case. Now, volatility in either consumer confidence or consumer sentiment, there's been more volatility in that than there has been in actual consumption. So I'm not suggesting dismiss the number. I think it's important, but anyone that thinks that is going to immediately point a needle to a quick decline in consumption, that hasn't been borne out based on what's happened. There's been in this cycle, this very unique post-COVID cycle, there has been a bigger spread and more variability between the survey-based data and the actual hard data. So soft data has had bigger swings. The hard data has not had. The other thing to know about consumer confidence is it's put out by the Conference Board on a monthly basis. Just based on the nature of questions that they ask, consumer confidence tends to ebb and flow based on the labor market to a large degree and perceptions of the labor market. And one of the sub-readings within consumer confidence was an expectation, a big jump in expectations around the unemployment rate deteriorating from here. Consumer sentiment, which ostensibly is measuring the same thing, kind of the confidence or sentiment, whatever word you want to use, of consumers. Consumer sentiment is put out by University of Michigan. The nature of the questions they ask tend to bias those readings more by what inflation is doing. That's why in 2022, when we had the huge surge in inflation, but we still had a healthy jobs market, consumer sentiment basically crashed and consumer confidence was more resilient. And people started questioning what's the methodology. And it was really as simple as one is correlated a little bit more to inflation, one's correlated a little bit more to the labor market. But I don't know if you read any of the regional Fed stuff, but we just got the Dallas Fed index and all the subcomponent parts. And sometimes some of the most interesting information from those is the verbatims from companies. And
Right.
maybe no surprise, there was just a rash of very heightened uncertainty. We are holding off on making decisions until we get a better lay of the land from a tariffs, DOGE, and immigration perspective. So that uncertainty, we're just taking a step back. That's pretty pervasive, and you're seeing it across the spectrum of that soft economic data like confidence measures.
All right, so which now leads us into this whole, what's the Fed going to do? Interest rate cut, no interest rate cut? Are they going to hold steady? Is there a risk that rates actually rise versus getting cut this year? Now it's interesting because after today's data, the 10-year, which was 4.62 a week and a half ago, closed tonight at 4.3. And it's been in this 4.3, 4.6 range for a while now. So it's going to be interesting that we see what happens next. But look, they made an aggressive cut in September. They followed it by 2 more 25 basis point cut in November and December. 4.25%, 4.5%, I don't think is usurious nor restrictive, really.
Yep.
I think it's kind of historically where it should be. But in my mind, I don't see how they can honestly justify a rate cut yet, because I don't see the labor market softening yet. And I do see inflation, trying to lift its head.
Yeah, I don't think the Fed's in a position to think about cutting anytime soon. I think market expectations will jump around with each data point. When you have a Fed that's data dependent,
Right.
and they're not just focused on their dual mandate of inflation and the labor market, but they're increasingly talking about the uncertainty associated with policy,
Right.
that's the reason why they went into pause mode. And I don't see that changing anytime soon. I do not think that their bias, at least as of now, is to hike in this cycle. I think it would take not just a significant acceleration from here in inflation, but some maybe overheating in the labor market. What I
Right.
think is reflected in the 10-year yield having come down to sub 4.3 intraday today is the potential for weakening in economic growth.
Right.
That may in and of itself be supportive of continuing rate cuts at some point, but not with the uncertainty regarding inflation as it relates to some of these policies. Because if you look at the collection of what's been proposed, implemented, delayed on tariffs, on immigration, let's leave DOGE aside for a minute. Peterson Institute has probably done some of the best work of actually quantifying this with data, without a partisan lens. All else equal, the collection puts downward pressure on growth and upward pressure on inflation. Now, the one thing I'll say about inflation is the combination of tariffs and immigration, particularly tariffs, does raise inflation, but not the rate of inflation over an extended period of time.
Right.
That's how inflation is measured, is year over year, month over month rate of change. I think it would represent a step up in the level of prices. But Kenny, why that's important? Because that's how consumers think about inflation. You and I can live in the weeds of month over month and year over year and core versus headline and core services, X housing. But people in the real world think stuff is more expensive than it was, a year ago or 4 years ago. So that a level step up, even if it doesn't mean consistently higher rates of inflation, could go into the psyche of consumers. And inflation is a fundamental thing that happens, but it's a psychological thing too.
There's no doubt. And the psychological part of it is the part that really gets people nuts, right? Because all they know is that every time they go to the grocery store, the food is more expensive, the chicken's more expensive, whatever it is. But let's just toss this in. Oil broke $70 today. I think it's trading at 68 and change. It is down $12 in the last month, right? I think it was trading at 72 a little bit ago. It's down not 72. Yeah, no, it was trading at what did I say? It's trading at 68, so it was trading up at 76, right? And so now it's back down to 68. And
that's going to help inflation, at least at the
100%.
Headline level. But it also is reflective of concerns about global growth. So
correct.
Right. So
Trump has made cheaper energy part of his mantra, right? That's what he ran
on.
It
is the mantra. But the irony is that the drill, other than existing wells, which can be profitable in the 60s, new wells, most private sector energy companies say
Right.
they need at least $80 for it to be profitable to drill.
Right.
So here again, there's cross currents, there's give and take that has to be part of the broader assessment.
Has to be part of the conversation for
Yep.
sure. But if oil continues to trend lower, that should help that whole inflation conversation because transportation costs should come in, utility
Right.
costs should come in, manufacturing costs should come in, right? People, I go to fill up my car. That should be less money, so that's going to, flow right down to the consumer. So it'll be interesting now to see how that happens. So let's just finish this conversation because today, if you read, the Bloomberg article at the end of the day talking about the markets and rates, it says that Fed fund futures are now pricing in 2 rate cuts after what
back
happened
up to
today.
2. Yeah.
Right, back up to 2, which I don't see it, but that to your
you know
point,
what? Who knows? This is sort of a fool's errand.
Right.
The market's expectations of how many and when will they go again, that's going to change with every data point, every inflation
That's
data
right.
point, every labor market data point. So the dart throwing of if you could tell me what the data is going to look like in the next 3 months, 6 months, then I could say, okay, I think they'll cut again, at the September meeting or at the December meeting. But we're just following what the market expectations are, which in turn is following the data as it comes in because of a data dependent Fed. So
Right, but I think the other thing that creates confusion and chaos around the whole thing is then they send out the different Fed heads, and everyone gives their opinion on what they think is going to happen, and so then the market reacts to that, right? Goolsbee, who's a real dove, versus some of the other ones that are not.
I call it the Federal Open Mouth Committee. Gone are the days under Greenspan when his was pretty much the only voice.
That's right, the only
and he
voice.
Used to joke that if you understood what he said, he wasn't doing it right. So
yeah. That's great. I love that, the Federal Open Mouth Committee. I think that's great.
I mean, in some way, there's not a lot that's wrong with that. There's more transparency and we get to hear the perspective of others, but it can sometimes add to the confusion.
It creates confusion.
Yeah.
It creates confusion, I think, in the markets. Again, to your point, people that don't, you and I may understand it because we live in this world, but people that read it or see it, and this one said this and this one said that, and then people say, well, how can they have two different opinions? They're on the same committee. Don't they look at the same data? It'll be that kind of a conversation, right? But it's always very interesting as we move through this. But I'm in the camp, that I just don't see it yet. Right now, I'll stand up and change my mind if the data starts to completely unravel. What I will say though, PMI services that came out on Friday, that's been in the expansionary territory above 50 for months and months and months. Friday, it came in below 50.
That's right. And manufacturing has been ticking higher.
Went up.
That's been another thesis of ours, that we were going to start to see some convergence, that this long period of the doldrums of manufacturing, 2.5 years now, and for the most part in that sub 50 territory, that we might finally start to get a lift. That might be arrested a little bit by virtue of all this, especially tariff related uncertainty. But we're sort of due finally for some bounce in areas like manufacturing and housing. I think housing needs what we've started to see, which is longer term interest rates and more freeing up of supply on the existing home size. But it's good to see that. But at the same time, we're seeing that rolling over in services. And that we'll have to see whether it's corroborated by the ISM version of the PMIs. But S&P's version is starting to get watched a little bit more closely. There's a lot of commentary that comes along with it. Chris Williamson, the S&P Global's chief economist, shares a lot of valuable information that comes out of those surveys. So we need to pay attention to that.
Is the S&P PMI, and the reason I say this to everyone listening on the call, is the U.S. is a 75% services economy. So when you talk about services PMI, that's very important because we're a 75% services economy.
And so let me mention it another way. Part of the reason why when manufacturing sunk into its recession 2.5 years ago or so, why the economy, and that's manufacturing is a leading indicator. So what we saw happen, and this is why the LEI, the leading economic index, is seen as having failed this time of calling a recession. But normally what happens is it shows up in the financial indicators first. Weakness in the equity market, check in 2022. inversion of the yield curve, check.
Check.
Not so much in the leading credit index because corporate spreads stayed relatively healthy, but we got a bit of a lift there. Then it morphs into the manufacturing side of the economy, check. It's just services, because it had the later turn up after the lockdown phase of the pandemic, we've at least elongated that span between manufacturing weakness and services weakness. So, but you're right, it's a much heavier weight in the economy and drives employment more. So that to
Right.
me is the real key, not just to see if services continues to weaken, but what does the employment data look like? The employment
Right.
components of these PMIs, as
Right.
well as just the data we all follow, like claims and payrolls and the
So
unemployment
is
rate.
there a big difference in your mind between the way the S&P analyzes the services PMI versus the ISM, the way they analyze it? Or is it
You
the
know
same
what?
data?
It's similar data. The questions are asked a little bit differently, but
Different,
you know what?
yeah.
I'm glad you just asked me that question because it's been a while since I did sort of a deep dive on the mechanics of each of those,
Right.
to see particularly when there are divergences, is there something that consistent that accounts for those divergences? I will say, I think, don't quote me, but I think because S&P is growing, S&P Global is growing in popularity,
Right.
they're not suffering something that the ISM has suffered from, which is declining response rates.
Right.
And that's something that we're seeing across the board of surveys, like the Bureau of Labor Statistics, the establishment survey that generates the
Right.
payrolls numbers.
So it
That
skews
has
the
seen
number.
the response rate has come down. The
Right.
JOLTS data on job openings, the response rate has come. I don't know whether it's people like you and I that if we see a spam call coming in, we're not answering it.
Right.
If you do answer and they say, I'd like to give you a survey, you basically hang up. So I don't know whether
Right.
we're just surveyed out.
Right.
Or whether the pandemic was such that companies, much like when so many companies just withdrew guidance altogether during the
Right.
first year of the pandemic because you didn't know anything. How do you know? How am I
That's
going to
right.
forecast my earnings per share to the cents three
Right.
quarters out when the world is locked down? I think
Right.
this ongoing uncertainty may make more companies reticent to sort of put themselves out there and try to forecast employment and new orders, et cetera.
So let's then flip this to now the whole federal deficit issue, right? That we've got this expanding federal deficit and debt. And so where do you see, at what point do you see this is going to become, it's going to come to a head and become this massive problem, or maybe not?
So I get that question all the time, and I don't know that there's some future moment in time that is some, collapse or crescendo or tipping point, whatever terminology you want to use, meaning we're going to default on our debt. I don't think that happens. There's going to
Right.
be some massive strike of buying of treasuries by, foreign investors or foreign central banks. No,
Not
many foreign investors and central banks have been diversifying away
right.
from heavy dependence on the dollar, but that's in the case of China diversifying away from dollars, that's been going on for more than a dozen years. That's not some new phenomenon. And by the way, China's not going to wake up one day and just decide to dump all their treasuries. They would be
Right.
aiming the gun squarely at their own economic foot. They'd probably do more
Right.
damage to their economy. That doesn't mean diversification won't continue. Could the bond vigilantes come back to a greater degree and push yields up? But for now, anyway, with ongoing concerns about the deficit and debt, we're not seeing that. The concerns are that interest on our debt crossed over what we spend on defense.
Right.
There are a lot of books that have been written over the centuries about literally that chasm being crossed, representing often a sign of sort of decline in global power. I'm
So
not going to go as far as saying that, but that's why that leapfrog garnered so much attention.
Right, but just so everyone understands, we're spending more on interest than we are in the national
Right.
defense.
Right.
That's what
And
that chasm was.
that's watched quite
Right.
closely. What the real impact of and by the way, I think the investor class cares deeply about this subject. I think constituents, voters care about it in the abstract,
Yeah.
but they don't tend to vote based on it. They're not going to vote either
Mhm.
for serious spending cuts or serious tax increases. So as a result, there's not a lot of real honest conversations being had in the proverbial room on either side of the aisle, especially with the desire to not touch entitlements. And we can talk about Doge and Musk backing away from the original. I'm going to cut 2 trillion. There wasn't 2 trillion to cut unless you go into that would be cutting all discretionary spending and then cutting into Medicare, Medicaid, Social Security. So he even backed down on that. We don't know ultimately what that number is going to be. The claims right now are is like 80 or 90 billion, but what's on the website is less than 10 billion. So we're so early in this that I'm not going to attempt to say what this means for the deficit. CBO estimates for the deficit are that it doesn't improve from here. Maybe at best it kind of levels out, which means when you're running deficits on an annual basis, you're adding to debt. Federal debt is the cumulative effect of running deficits. The real solution to this problem is not draconian. It's getting to a point where the growth rate in debt is lower than the growth rate in the economy, because then you start chipping away at the problem. We're not there, but that's how you fix this. It's over time, but there's no wand to be waved that fixes this. But it does act as a suppressant on economic growth. When high and rising burden of debt, that's the United States, that's everywhere else in the world that has a high and rising burden of debt.
Right. Well, they could also, I mean, correct me if I'm wrong, they could also slow down on their spending because that's adding to this problem. Right?
Yes. Oh, no question about
spending.
it. Yeah.
Right.
Now, in terms of the long-term trend of how much is coming in via tax revenue, how much is going out via spending, spending is more the problem than the revenue side. The question is how you do it, how draconian the cuts are. Do you leave entitlements completely off the table? So those are the big picture questions. And I'm not sure the leaving entitlements off the table, I'm not sure how we get to a point where this becomes manageable without some attention to entitlements. But that's above or below my pay grade. I'm not sure in this case.
Right. But I think, so let's talk about just Doge for a minute and where he's going and kind of where he's finding it. I don't think I'm looking at it as if it's more finding the waste, not so much fraud and abuse, but where are we just wasting money, right? Where are they like in the, Department of Defense, they're paying $200 for an HDMI cable. You can buy it at Walmart for $10. I mean, stuff like that, right? That's wasteful spending.
Look, if we really could just fine tooth comb this into nothing but waste and fraud, same thing as if we could just focus on, illegal immigrants that have committed crimes. The problem is that it's a bit more scattershot at this point. And that's what's adding to the uncertainty. At some point, it's going to have to be a bit more fine-tuned. And we're not there yet. And it's, as we know, it's causing uncertainty at the state level and at the local level, and there's pushback now. So this is the sausage making of how things get done in Washington. But all of it
sometimes
is adding
it's not
to uncertainty. No, it's not pretty right now, and it's adding to that uncertainty.
Right. So let me ask you another question about sector rotation and leadership now in the markets, right? Because we talked about, actually, I think you and I were talking about before it began. Today, for instance, the Dow closed up 260 points. And
because
NASDAQ
it doesn't have a lot of tech and tech-related exposure. It's got more exposure to areas like staples and
staples. Yeah. So we even saw it last week, and one day I forget, I put it on my note because I think consumer staples rallied by 1.2% when the market got crushed because it's the flock into consumer staples, right?
You need
staples versus discretionary, right? Discretionary are wants and staples are stuff that you need. So even if the economy, suffers a tough time, you're still going to go out and buy the stuff that you need. And the consumer staple stocks tend to also be, dividend payers. So, you're going to get paid for owning them, and they tend to be defensive. So to your point today, there's a fair amount of those in the Dow. And so, with the NASDAQ kind of under pressure, the Russell was under pressure. There's that angst and nervousness. And so, you go into that defensive trade, right?
You snuggle up to staples,
utilities,
healthcare.
Right. Utilities is another place.
Well, utilities has both a defensive component, a traditional defensive component, but then it's got the AI tie-in. So it's kind of a funky sector where sometimes it's up there when the more traditionally defensive sectors are doing well, but there have been days where AI is kind of under pressure and utilities sort of fall. So It's sort of in the eye of the beholder as to what you see within utilities, whether you see it as an AI play or you see it as a dividend yielding defensive play. It's got a little bit of both.
So are there one or two, say the broad 11 S&P sectors? Are you still out there assuming or telling people that, clearly they should be diversified and all that stuff, but are you legging in on one or two more sectors as we go into 2025?
Yes, but the answer is going to be longer than just telling you what the ratings are on sectors. So we have two outperform ratings right now. That is on actually communication services
Right.
and financials. And communication services, it's a little bit of a tangential comment here, but I think it's an important one. Some of these sectors, and the most extreme example is communication services. Meta and Alphabet, just two stocks, represent 70% of that sector.
Right.
Which is also important because people who like to buy sector ETFs
Right.
think that they're getting the same exposure to the S&P sector, but any ETFs has a limit on how much they can own in any one individual stock. So if you are buying a communication services fund, you're not going to get the same exposure. Maybe that's a good thing because that's a heck of a lot of concentration. But so those are the two sectors we have outperform ratings on. Consumer discretionary, we have an underperform, and then the rest would be in that neutral category. All that said, that's not been a big emphasis for us. What we've been saying to our investors is even if you want to take that sector approach, you can't really do it monolithically. You kind of have to have an overlay on top of that. We've been very factor focused. So for viewers that don't know what a factor is, factors are characteristics, right? So screening for tracking performance based on factors, return on equity, free cash flow, valuation. There can be factors associated with valuation, price to book and price to earnings. Momentum is a factor. Low volatility is a factor. High beta is a factor. So there's been more consistency in leadership at the factor level than there has been at the sector level. So to say outperform on financials has a lot of different kinds of stocks in it. Right. And at least you want to have that factor overlay. And we've had a quality bias toward the factors that we're emphasizing. And that's been the case for the past year or so. But we've recently added in almost kind of a GARP type approach, to use an acronym that we used to use all the time 10, 20, 30 years ago, growth at a reasonable price. So not just looking for those growth-oriented factors like positive earnings revisions, positive earnings outlook, but make sure you're not paying overly expensive valuations for it. But then the more recent factor we've added into the mix is that low volatility factor. And that's been one of the best performing factors in this most recent couple-month period of transition in terms of leadership.
So is that factor-based investing, is that what's leaning towards communications and financials? Are those the two sectors that are coming up?
In the case of communication services, and this is not my area, meaning I don't work directly in Schwab Equity Ratings. So I want to tie in that. So Schwab has Schwab Equity Ratings. We rate more than 3,000 stocks domestically, and then about the same internationally. So about 6,000 or so stocks that we rate. Our ratings are like old school grades. A, B, C, D, and F. So A's and B's are buys, C's are kind of holds, and D's and F's are, sells. Well, I already mentioned that Meta and Alphabet represent more than 70% of communication services. Right. I think they're both B's, but essentially buys. So that's part of the reason why there's an outperform. It's kind of that bottom up. I can promise you that if Meta and Alphabet were F-rated stocks, we would not have an outperform on communication services.
Yeah, right.
But our Schwab Equity Ratings work, as well as the quantitative side of our sector ratings, they're factor-based. So that work is factor-based. So it makes sense for us to also talk more broadly to our clients about the benefit of having that factor focus. And there's so many more firms doing factor research, offering factor screening. I'm sure your viewers are hearing that term more and more because it's much bigger part of the way to think about investing.
Right. Well, people pay, yes, because to your point, because it sheds new light, sheds kind of a different light on right.
And it gets
Just,
to the heart of
sector
fundamentals.
investing.
And one of the nice things for investors, for stock pickers, for active managers is there's increasing connectivity between fundamentals and stock prices. Macro is having less of an impact, believe it or not. And with the return of the risk-free rate, with the Fed coming off the zero bound after the pandemic, we have this renewed price discovery and a greater connectivity between fundamentals and prices. All the more reason why that factor-based approach makes a lot of sense.
Right. So let me ask you a question. How have you felt so far about, the first quarter earnings season? Have you been satisfied with it? Were you disappointed?
Well,
Were
it's
you
actually
encouraged?
fourth quarter earnings season
Fourth
being
quarter, right.
reported in in
Right.
first
Fourth
quarter. Yeah.
quarter. Right.
Yeah,
Yeah,
no,
yeah.
it was, I mean, the beat rate, I haven't looked in a couple of days, but I think it was somewhere in the mid 70%
Yeah.
range.
Yeah.
That's fine. That is
Yeah.
below the past 4 quarter average, but a little better, but in line with the long-term average. The growth rate, as we sit now almost at the end of the reporting season, is up to about 15%. At the start of earnings season, before the first company reported, expectations were only for about 9.5% growth. So that's a pretty big
So it's
jump.
better.
The
Right.
rub, though, is that there's been no follow through into 2025 estimates. Those estimates have come down for all 4 quarters and have come down from about 15% a month ago now to about 10 or 11%. So some of that is the math of base effects. So 2024 is going to turn out to be a bit better. So year over year has to be haircut a little bit because you're coming off a higher base, but that doesn't explain all of it.
Right.
Companies have been increasingly talking with concern about the outlook and uncertainty with regard to the outlook, mentioning tariffs even more than at any point in 2018, expressing not concern, but uncertainty with regard to the ability to maintain profit margins. And when we were up at a 14% expected earnings growth rate for calendar year 2025, that was predicated on record-breaking profit margins. I think that's the component now that is being called into question. That's the uncertainty component for 2025, and why you have not seen analysts just move in lockstep with the better fourth quarter and sort of apply it to this year. We might find out that the bar got set sufficiently low again, and we, beat the lowered expectations, but we won't start reporting first quarter until, April. So we have some time to wait.
Right. So talk about, where's the S&P right now? At about 22 times?
Yeah,
Is that what it is?
so about 22 in
times
the
earnings.
aggregate. If you look at either the Mag 7 or look at the 10 largest stocks, you're closer to the 30 level. If you look at equal weight, or if you look at S&P X Mag 7, to eliminate that component of what has brought, you're in the kind of high teens. So it sort of depends on how you slice it, dice it. Now, that's expensive, certainly 22. I will say, though, that valuations in general have been coming up over time as the U.S. economy has become more of an innovation economy. And so that naturally sort of allows the valuation metrics to trend higher. Starkly different than if you are an economy like Australia that's mining oriented. And that's also one of the reasons why, when looking at valuation and doing comparisons to another country or another region, be really careful in trying to do apples to apples comparison, because there are parts of the world that are always cheaper than the US because they might not, they're not an innovation economy. They might be more of a basic materials or commodities oriented economy, or financials might dominate. So that's important. You've got to understand, you've got to have that additional filter of what's the nature of the economy and what that means for levels from a valuation. The other thing I'd say about valuation, you and I could talk for the next several hours on, is the market expensive or is it cheap? There is no correlation between this P/E ratio at any point in time and subsequent one-year returns in the S&P 500. There's no correlation. It's not a market timing tool. I don't know that there is a good market timing tool, but valuation, if you go out 10 years, and you look at starting point of P/E ratio, forward P/E ratio, and subsequent 10-year returns, then you start to see what would seem to be an obvious relationship. Cheaper starting point, better returns long term, but with, say, a 1 year time horizon, there's no correlation.
So, but tell me what your sense is about this recent volatility then. Is the recent volatility, do you think, going to be short-lived? Do you think it's going to extend a little bit longer, into the end of the quarter as we go through, more policy, more conversation about what's happening in DC, the whole tariff thing as we see how that unfolds?
Interestingly, last year was a year sort of defined as very low volatility in the aggregate for the US equity market. You didn't see major dislocations in the volatility index, but the action from a volatility standpoint last year was in the fixed income market. So the MOVE index, which is akin to the VIX, but on the fixed income side of things, it measures bond volatility. That was where the volatility action was. Recently, we've had a little bit more stability, kind of a slowdown trend in yields, as we already talked about. It wouldn't surprise me if we now have a little bit of a mirror image of what happened last year, where a little bit more volatility works its way into the equity market, even if it's not commensurate on the fixed income side of things. But also, I don't know that I would judge or measure volatility purely on the surface of cap-weighted indexes by looking, say, at a measure like the volatility index, the VIX. There's a lot more that goes on under the surface that we should think of as volatility that might not manifest itself in something like the VIX. One example of that is over the trailing 1 year period. The S&P has not had a 10% correction. The worst decline it's had was 8% in that late summer period of time last year. The NASDAQ did have a 10%.
Which, by the way, 8% is in the normal band of trade.
10% is in the normal.
That's right.
The NASDAQ did have a 13% correction around that same period of time, starting in mid-July. But Kenny, here are the numbers maybe that tell the fuller story. The average member within the S&P 500 in the past year has had a maximum drawdown of 22%. That's bear market level declines. Do you know what it is for the NASDAQ? The average member maximum drawdown? It's just shy of in the past year. The average member has had a maximum drawdown of almost 50%.
Almost 50%.
Almost 50. So the cap-weighted indexes have benefited from the mega caps, especially last year, where the Magnificent Seven were all strong performers. They weren't the 7 best performers, but they were all strong performers. But the fuller story is told under the surfaces. And there's been a lot of churn and a lot of rotation and leadership shifts, even in an environment like last year, where if you were only looking at the indexes, it'd be like, great year, nothing to see here, low VIX. But again, the fuller, maybe not the real story, but the fuller story is told under the surface. So I think that churn under the surface, leadership rotations at the sector level, I think that type of backdrop is probably going to continue.
Well, and look, and even today, like I said, the NASDAQ, I think, is down 5% off the high most recently as of tonight. Yet, if you look at some of the members within there, they're down 15, I think NVIDIA is down 18%, 15 or 18%, right? Tesla. I mean, look at all these names that have really gotten crushed there into that bear market territory.
Only Meta this year of the Magnificent Seven is outperforming the S&P. But it's not one of the top performers. It's ranked 52nd out of the 500 stocks. The next best performer is ranked 335th, and I think that's NVIDIA. The worst performer, which is Tesla, is ranked, I think, 490th. So a lot more dispersion and weakness, even in those kind of prior darlings. But there's enough strength that it's finding its way into other areas that it hasn't meant a collapse. That, by the way, it's terrible to use a battlefront analogy, but it's the one that's always been used to describe market breadth and participation. I have to come up with a better one. Maybe you'll help me think of one that's maybe uses football or something. But the idea is that if you only have a few generals on the front line, even if they're 4-star generals, but the soldiers have all fallen behind, that's not a very strong battlefront. But if you have the generals start to fall back, but if more soldiers have come to the front line, that's a stronger battlefront. So that's the way to think about this. Now, bear markets can happen, and then everything drops. So far, anyway, we've seen this corrective phase in the Magnificent Seven and some of the other mega cap tech and tech related names, but there's strength being found elsewhere, and it's sort of tempering the blow for now, anyway.
Right. Well, for now anyway, and I guess that's kind of, that's kind of the big question, right? Is it all is the bottom gonna fall out and everything's gonna start to implode or not? I don't think it is, right?
If the economy can hang in there, but if the weakness we're starting to see persists and you start to see, recession probabilities pick up, then you have to put a potential bear market in your sights. I mean, that's just the nature of the beast. But
I'll be the first one to raise my hand and say I'll change my mind, but I'm not there yet.
For now, no. For now, there's enough economic strength. There's enough strength in the labor market. But to use sort of a weather analogy, given all this uncertainty, given what we're seeing particularly in the soft data confidence measures, I would say a more significant weakening in the economy. I don't want to say recession necessarily. Should be something we're on watch for. You know how weather, the first thing is a watch, then there's the warning. I don't think we're at the warning phase, but we may be at the watch phase.
Right. Do you think, where are you in that? Do you think we're going to avoid a recession, or we're going to have a slight recession, or no recession?
Well, will we get another recession at some point? 100%. That's just how cycles end. This has been incredible. By the way, to say that we've come through this cycle unscathed since the short-lived COVID-related recession, that's not really accurate. We have had recessions in manufacturing, in housing related. It's just because we had the later strength in services a larger employer, that kept the labor market healthy. That was enough of an offset that it didn't morph into a full-blown NBER declared recession. But we've had sectoral recessions.
Right. So we had, I like to call it the rolling recession.
Rolling recession, rolling recoveries. I think that could persist if this convergence that recently happened with services and manufacturing persists. It could be a situation where we watch services sort of take their day in the clouds after being in the blue sky for a while.
Yeah.
But you get offsetting stability, if not strength, in areas like manufacturing and housing. So it is possible we could continue to see a roll through, and it doesn't result in an NBER declared recession. But I don't think recessions have been outlawed. We will get one at some point, even if it's not imminently in the cards.
When the yield curve inverted, 3 years ago, the recession was 16 months away and it never came, right?
Well, inversions tend to be the watch. Right. Uninversions tend to be the warning. Right. So, we're uninverted now. It'll be interesting to see. I heard somebody today, I had Bloomberg on in the car, Bloomberg Radio, and I heard somebody made a comment about a possible renewed inversion of the yield curve if short rates stay steady, because the Fed, even with weakening economic conditions, opts not to cut, but the long end continues to come down, reflecting weaker economic activity. You invert the yields curve again. That would be interesting, because it would represent yet another thing about this cycle that is an apple compared to history's orange.
Right. All right. So listen, we've got a couple of minutes left. So before I say thank you, I want to ask you one more question about what are the important takeaways for the people on this call today, for investors that are listening, in your view, that they should walk away with.
You know what? So much of what we talked about, Kenny, actually doesn't matter in terms of what are the keys to long-term success for investors.
Right.
What we talk about is maybe the more interesting stuff to talk about. But as you well know, long-term success is being disciplined over time.
That's right. And having a plan.
Diversification and having a plan, and understanding whether there's a wide or narrow gap between your financial risk tolerance and your emotional risk tolerance, and not just the benefits of diversification, but the power of rebalancing. You and I do TV all the time. They're not going to want us to talk for 5 minutes about diversification across and within asset classes and periodic rebalancing. It's like, ho-hum snooze. But having a long-term plan and making sure your strategic asset allocation is tied to your long-term goal. But we know that's what matters.
Right. And understanding, I think one of the key points is really understanding your risk tolerance, right? I mean,
Yeah.
being very comfortable with where you think
Right.
you are. And look,
And
some of that
that's
also
the
depends on where you are.
financial risk tolerance versus emotional risk tolerance. We might,
Correct. And
on paper, say, oh, yeah, I have a long time horizon. I don't need to live on the income. I can
right,
take the risk.
right,
But if you are going to freak out and panic and sell everything at the first 15% of drop of your portfolio, your
right.
emotional risk tolerance and your financial risk tolerance are two entirely different things.
Two very different things. And it's interesting, you also, part of this is, and I think most people recognize this, is you also compare that with where you are in the life cycle, right? So a 30-year-old versus a 60-year-old, right? Understanding because when you're 30, you're much more risky, and you should be. But you get to be 60 or 65.
That said, I think age is certainly a factor, but that can trip people up too. You might be a 30-year-old investor, but if you are going to freak out at the first, bear market, even though you
right.
have ostensibly 30 years, maybe you shouldn't just tie your risk taking to your age. I had the great pleasure of meeting Sir John Templeton. He was a guest on Wall Street Week when I was a panelist. He was in his early 90s at that point, and
Yeah.
he was a very aggressive investor in his 90s. Clearly not a time horizon perspective. Now he was a billionaire. That might come into play as to how much risk you're willing to take. So there's that. But so I think age is a component of it, but understanding what is my freak out threshold.
Right. What's my freak out? Right.
Yeah.
And there's one last question, because this came up a lot over the weekend, because the news came out that Warren Buffett's got $335 billion just sitting there in cash. And what's the cryptic message that he's trying to send? Is he telling us that, or is he trying to send the message that he thinks the markets are going to crash and he's just going to sit there and say, take it all in when it comes?
Right. He just is not finding opportunities that are appealing to him right now, and cash is generating a return.
Right.
No one should suggest that is some subliminal message to what individual investors. Berkshire Hathaway is a massive conglomerate of companies.
100%.
He's not trading 100%. Some portfolio of value stocks. So
right.
his views are important. His perspective is important. He's the oracle. I mean, he's an icon. He's a god. But
and I laugh because on Monday morning I got the phone call from a friend of mine who said, "What's it mean? What's it mean?" I go, "It means nothing."
It means that right now he's not.
You shouldn't change your portfolio because he's got 335.
You are not running the same kind of portfolio as Warren Buffett is.
I go, "Are you hiding 335 billion from me that I don't know?" If you are, we'll have a conversation. Anyway, listen, it's 5:00. I really, really appreciate this. This is the third year you've done it for me. I am so grateful about that. SlateStone's grateful about that. I think everybody that was on this call today, I hope they got from it what I hope they got from it. Some great insight and conversation and some entertainment with you and I. In any event, I will see you this summer in Nantucket.
I hope so. It's always great to see you. Send the best to the family, and thanks for having me. Okay.
Thanks.
Bye, Kenny.
My pleasure. Bye-bye. Bye-bye.